Most of us recognize we're going to have a recession in 2023. The only debate is about how severe is it going to be, and the range of possibilities goes from a soft landing, or on the other end of the spectrum, perhaps even another Great Depression. The Federal Reserve is attempting to engineer a soft landing. That means that they're going to bring inflation down, prices on the shelves will come down, and they're going to do this without pushing the economy into a sharp recession. But then you've got hedge fund manager Michael Burry, who you know from one of my favorite movies, The Big Short. He warns of an extended multi-year recession. And no range of possibilities would be complete without bringing in Dr. Doom, Nouriel Roubini, who's warning of another Great Depression. The good news here, and I know that it doesn't sound like there's a lot of good news, but there's plenty of good news because there's many moves that you can make in any event, any scenario that you probably should make and possibly could make to better your position, land on your feet, help the people you care about. So what's causing a recession? What does it look like? How is it going to affect you? And most importantly in this video, what you can do about it. For many of you, this is your first time here. My name is Peter Leeds, and along with my extraordinary team, we publish one of the most popular financial newsletters of all time. Nothing in this video is intended as personalized trading advice for you. For a long time, you were told that recessions were when you had 2 quarters of negative GDP growth, which is what we had in quarter 1 and quarter 2. So technically that was the recession, but then they felt that they're going to change the way that they look at a recession. They say, well, that wasn't a recession, even though the economy was declining, because there's very low unemployment. And other factors in the economy were strong enough to say that that recession wasn't actually a recession. So they're mincing words, they're arguing about that. But take a look at this chart from the National Bureau of Economic Research. It shows you unemployment and recessions historically. The gray areas are when there was a recession. And you can see right now that our unemployment rate is incredibly low. Actually, anything below this level is going to put strains on businesses and the economy. But this is one of the things that's going to increase going forward, especially because a lot of layoffs have already been announced. And as they work through the economy, they absorb into the economy, you're going to see the unemployment rate increasing. And you can see here, this is a recession brought on by the big thing that the entire world had to deal with over 2020. And that recession began in February 2020 and ended in April. That's according to the National Bureau of Economic Research, and that was the shortest downturn in U.S. history. However, it took the economy until July of 2022 to finally recover the 21 million jobs lost during the slump. So the recession came and went, but the effects of the recession took a lot longer to deal with. Now here's a chart from the Conference Board, and this is their U.S. recession probability model. And you can see that the probability, according to the way that they calculate it, is pretty close to 100% right now. That doesn't mean it's going to start right now. It means that there will be a recession in the very near future, according to their recession probability model. But you might be wondering, what causes a recession? And I guess I'll take a crack at it. A lot of quantitative easing, creating new money, easy monetary expansion, low rates. So the Federal Reserve had the rates so low for so long, and it was so easy for companies to take on debt, to expand and hire people. It really got the economy heating up a lot. Then there was an overreaction to the whole lockdown where a lot of companies were worried about the supply chain disruption, so they overloaded inventory when they had the chance to do that. So they bought more inventory than they actually needed. And now, as the economy slows down, a lot of these companies have all this inventory sitting in their warehouse. Then there was a reopening trade, and people were very exuberant about that. And that pushed even more drivers of growth, which made the economic expansion even stronger. And natural cycles in the economy just happen to be natural cycles. Periods of economic expansion and then periods of economic contraction. An economy is like a lung. You breathe in, you breathe out. And then the Federal Reserve says, don't worry about this overheating economy and inflation. What we're going to do is engineer a soft landing by raising interest rates, punishing the economy until the unemployment rate rises because companies can't afford to keep all their employees. So as they raise rates, that's going to be possibly and almost certainly driving this economy into the recession that it was going to happen. Either way, this will speed it up. And then you combine recency bias with fear of missing out, and that just drove everything even stronger. I always say the analogy of the raft. Everybody goes over to one side of the raft and it starts tipping, and then they run back all at once to the other side. We had one side of the raft being expansion, wild expansion. Before the shortest recession in U.S. history, the period leading up to that was the longest U.S. expansion in history. But there's plenty of indicators telling you that a recession is coming besides all of the things I just talked about. When you see an inverted yield curve where you're getting paid more to own bonds of shorter durations than if you owned bonds of longer durations, that's an inverted yield curve. There's been inversions all up and down the yield curve. And as they used to say, 2 quarters of negative GDP growth, there was your recession until it happened. And they said, no, that's not what we mean. Just remember that most of these things are leading indicators, meaning that you might see an inverted yield curve says a recession is very likely or almost certain, but it's still sometimes 2.5 years before the recession kicks in, sometimes a matter of months. But let's take a look deep under the hood. This is from Franklin Templeton. This is the anatomy of a recession. And you'll see the X's represent that we are in recession for that factor, whereas the yellow circles are warnings of approaching recession. But what does the recession look like? Why is everyone so afraid of it? What happens is that unemployment climbs, businesses and people start spending less money. The velocity of money declines. And then, next step, businesses and people start feeling the crunch. We've gone from people starting to spend a bit less when they see the prices in the grocery store shelves to the point where now they're really starting to feel it. And when you add upcoming layoffs to that, it's just going to make it that much worse. And then the next step is that you start to see all of these media scare tactics, I'll call them. And they're not scare tactics because a lot of them are legitimate. They're just telling you what's going on and how much harder it is for average families to afford their lifestyle. But that's what you see on the news. That's what they talk about. That is the top topic that everyone's dealing with right now. Here's the good news, though, about inflation. And unlike most people, I told you that it's going to come down. And one thing that's going to happen, it's going to come down. And when it does, it'll come down relatively quickly. Here's a chart of the inflation rate. And we're all going to find out at the same time on Tuesday, December 13th, what happened with inflation in November. That's going to be when the U.S. Bureau of Labor Statistics releases the Consumer Price Index data for the month of November. And I expect that to show a further decline in inflation. We'll see how it goes, but we'll find out on December 13th. And the good news I promised you, there's moves you can make. The types of stocks you want to invest in, recession-proof investments, the types of stocks you want to avoid. Certain sectors tend to perform well during recessions, not only in spite of the recession, sometimes because of the recession. But just before we get into the stocks that are to be avoided, stocks you might want to gravitate towards, and remember that nothing here is intended as personalized trading advice for you. You also want to limit any wrong or unnecessary purchases. Don't go out and buy a Rolex watch. Not right now. Buy it in a couple of years. Just really think about everything from a perspective of wants versus needs. I would suggest that educating yourself at this point is a really good idea. Things such as the Peter Leeds newsletter is going to help you a lot through all of this stuff. Sometimes it's worth it to learn some things so that you can protect your wealth and build your wealth. It's an investment. Some of the sectors and industries that'll do well during a recession sometimes is communication services, your cell phone provider. They've got the ongoing monthly revenue that they bring in, and that stays pretty stable. Consumer staples do well. Energy, depending on the factors driving it, can do well in recessions, not necessarily always, because there's so many more factors that are really pushing energy prices around. Healthcare stocks can do pretty well. People tend to put their well-being ahead of any problems that they have from inflation and from recessions. And sometimes it's not even a choice. Commodities can do well, even especially in times of inflation, when all prices are going up. Prices of things like coal, corn, precious metals can all increase, just like houses and stocks increased with inflation. Precious metals are one that I truly am stoked about. I truly believe, and I think that gold is about to have a really good run in 2023. Rental units. If somebody's got 6 rental units in an apartment building, those typically, even though real estate could take a massive hit during a recessionary storm, rental apartments will be recession-proof in the sense that you can adjust the rents over time depending what the situation is. And typically, any strategy of renting out a place works out pretty well for companies that do it and for individuals that do it during a time of recession. That's why you saw in the Great Depression so many people renting out extra rooms in their house to complete strangers. It was just a thing that a lot of people did. Pharmaceuticals goes back to the healthcare thing. People are going to buy the drugs that they need, no matter what's going on with the economy, depending what the illness or affliction is that they're trying to deal with. Grocery stores can do well. Certain types of grocery stores, lower end grocery stores, dollar stores, places like Walmart. And what we're seeing right now is that the fastest growing portion of Walmart's customer base is people who never shopped there before, and now they've sort of ratcheted down a bit. They're making over $100,000 a year, and now they're going and shopping at Walmart now because of all the hardships of the economy. And they didn't do it before when things were a bit better, but as things get tougher, you're finding a lot more people who are financially okay, they're starting to shop at Walmart. Utility companies with ongoing revenue each month usually do well. And a big one is cash. Cash, I see it as being able to take advantage of the opportunities. And people wonder, didn't you say that the dollar's losing its purchasing power? Yes, it is over an incredibly long period of time. But in the short term, you get into a recession 6 months from now, there's going to be a lot of opportunities to act on then. And cash is going to be one way for you to take advantage of a lot of those. I told you more millionaires made in the Great Depression than any other time in history. And a recession is just a lower level than a depression, but it's the same kind of setup. You're still going to have a lot of bargains and opportunities you can take advantage of with any cash, any dry powder you have on the sidelines. And money market accounts consider that just like cash. You get paid a little bit, they're pretty safe. But if you want to take advantage of an opportunity, you can get access to that money pretty quickly. You're liquid. And U.S. Treasury bonds usually hold up pretty well as the cleanest shirt and the dirty laundry hamper, or the best of a lot of bad options. You'll see in just a second that you don't want to get into high yield bonds, but American government Treasury bonds have a history of holding up better than most investments during a recession. So that's some of the things that typically can do pretty well. Some things that'll do bad will be real estate investment trusts, companies like FedEx that are a demonstration of the activity of the economy. When the economy slows down, a company like FedEx will take a hit from that. They'll have less business. Highly speculative stocks, consumer discretionary, if you're going to go buy a fancy $500 pair of jeans, that company might not sell as many jeans in a recession. Luxury items. And I was also going to talk about the high yield bonds. You can avoid them during recession. These are bonds with very low credit ratings, below investment grade, and they're riskier than government debt securities, which can do okay in a recession. And these are bonds that are a little bit riskier, so they have to pay a higher yield to sell the bonds that they're selling. Those are highly susceptible to market downturns. A lot of these companies that issue the high yield bonds are highly indebted. They owe a lot of money. Now with interest rates going up, it's going to make it even tougher for those companies to pay what they owe. So any highly leveraged companies, investments when you're going to buy a company that they have the stock, you like the company, you like the stock, but they've got way too much debt on their books, and now they're going to have rising interest rates. They're going to have higher carrying costs. So it'll be more difficult to pay what they owe. And what you're seeing is a whole bunch of zombie companies now that are going to get absolutely hammered by the increasing interest rates. David Traynor, the CEO of investment research firm New Constructs, believes there are roughly 300 publicly traded zombie companies. These are companies that can only pay the carrying costs to float their debt, or they can't even do that. And these are companies which they're already treading water, and then interest rates increased, and now they have to pay more for the carrying costs. Their debts just get more painful for them. They have fewer options of what to do. So what can you do with all these things that are coming down the road at you right now? You can get educated like you're doing right now with content from this channel. You can adjust your lifestyle. That unfortunately is not going to be a popular thing to say, but it is just the situation that we are in right now. And understand that going forward, the investment environment and the economic environment will be very different than it is right now. If we get into a recession in 2023, there's going to be a lot of moving parts and a lot of ways that you are going to be affected directly. You're going to know people who are losing their job. There's an old adage that says if your neighbor loses their job, that's a recession. If you lose your job, that's a depression. So at very least, do yourself a favor, subscribe to this channel. It's just one click right now and you get more great actionable ad-free videos just like this one. And stay in touch with us because we're going to try and help guide you through a lot of the hardest times which are just ahead of us right now. And the good news is that there's plenty of opportunities. Some people are going to come out the other side of this in a better position than they are right now. You want to be one of those people. And if you really want to get a lot more videos just like this one, please consider joining the Peter Leeds Army. And if you want to keep the education going, check out this video. It's a perfect combination. How to beat inflation with stocks that are trading for less than $3 each. And you take everything we just talked about now, and then you watch that video, and it makes a perfect strategy about what to do, how to land on your feet during this difficult time.